Is that resilience since the rally surprising you?
There are a few things happening in the market at the moment on the physical side. Actually, three really important things. We are seeing a rebalancing of crude from the Pacific to the Atlantic. There has been a very strong demand, especially on the gasoline side in the Pacific. Refinery margins have been very strong in Singapore, etc. And all those Arab grades, Saudi Arabia has been pumping, and the rest of the Middle East, etc., has been pumping into the Pacific, has been very, very strong. Now what's happening is that physical crude market in the Atlantic, the North Sea, as well as West Africa, there's a lot of surplus barrels here, that's being pulled towards Asia. And I think that's where we are seeing the seemingly stabilized market at the moment. There's nothing more than that.
I have to say, the oil story is getting highly complicated. A bunch of narratives out there, Ms. Nguyen. Saudi pumping a record number of barrels a day, U.S. production potentially slowing according to the EIA. Which story do you think is taking hold of prices right here?
At the moment, the market is very much focused on expectations on U.S. production slowing, more so than the actual data. The actual data, in fact, is being revised higher. Q1 growth for U.S. supplies have been revised higher. The entire base has moved higher. But now it almost seems like the expectation is for this slowdown to be very, very sharp come the second half of the year in 2016. So those expectations are taking hold. And the second thing, and this is linked to the Saudi point that you've just mentioned, is yes, there is strong demand. And at the moment, and even OPEC sort of said, they had a very happy meeting, things seem to be going really well. The point is, refinery margins are looking very, very fragile come 6 to 12 months from now. You're seeing that in jet fuel already in Europe, and that sort of passes over into gasoline, diesel come Q4, because Jubail, all of these units are going to be ramping up their diesel supplies come second half of the year.
At the end of last year and the beginning of this year, everything was on that supply and demand dynamic, yes, and that was driving oil prices. Yes. Are there other factors that are coming to the fore a bit more this time around?
Yes, so the strength in refinery margins again. It's been very surprising that Europe as well, where people have been very bearish on refinery margins, both gasoline and diesel, we've seen a lot of strength come there. And the point we're trying to make is now we're seeing this shift in barrels. The crude surplus is becoming a product surplus. That will start weighing on refinery margins come the second half of the year, and that in itself will feed through into weaker crude prices.
Okay, so I want to talk about inflation, because I think that's one part of the puzzle, yes, that's missing here. Repricing inflation expectations is changing the story when looking at the bond market. How is it, if at all, changing the oil market and your forecast for oil prices and where they go from here?
So in terms of crude, we don't see that big of a difference in terms of where the forward curve is pricing the curve, let's say 2016, 2017. It's very much in line with it, if not slightly bearish. And our view is that come 2016, we still see a lot of optimistic US producers out there. They are also looking at this strength. And what it means is they will, possibly even change their plans when it comes to reducing supplies come 2016, 2017. So it's very much a seesaw market, and we are still not out of the woods.
Your year-end targets?
We have an average forecast of $60 a barrel for Brent.
So right where we are trading at right now?
Yeah, somewhere there.
Ms. Nguyen, thank you.